Hey, Katie. So as much as things are soaring, technically, it looks like there's room to run.
The uptrends are definitely supported by positive intermediate-term momentum, and we've seen real meaningful improvement in long-term momentum as well, even behind the turnaround types of sectors, things that don't look just like the triple Qs, but other sectors that had downtrended for a couple years ahead of their basing phases. So there are very redeeming qualities, and yet short-term momentum has certainly fallen off a little bit, and that's something that we have an eye on from a technical perspective. It's not at the point where we're seeing decisive sell signals, but we're at the point where we are shying away from adding new exposure at current levels. So we're kind of a medium level hold here, not a weak hold, not a strong hold, but a hold. So
what are the levels that you're watching from here that will kind of get you off the dime one way or the other?
Well, for the triple Qs, as mentioned, there is resistance, and it's not until the 2021 high, and that's, I think, something close to 8 or 9% above. So that seems really very aggressive, quite frankly, as an upside objective based on where we've come from. So because the support level, and we're using the rising 50-day moving averages, generally speaking, as gauges of initial support, because those are somewhat far below, that doesn't create the best risk reward, even with the resistance for the triple Qs about 8% above. So we're in this mode where, again, we're not adding no exposure with that in mind. We usually like to see a reward to risk of better than 2 to 1, and we don't have that at this time, and that goes for not only the triple Qs, but areas like the semiconductor sector as measured by SMH. SMH still has the support of positive momentum as well, but it also faces resistance from 2021. It's right around 160. You can see it's a very strong level, but through that, of course, would be a nice breakout. So we want to be there just in the event that it can break through. Other names to watch might be Microsoft into earnings with the resistance around 350 essentially being tested. A breakout would be bullish, but if it fails to break out in response to earning, of course, that would be a setback.
The SMH is so interesting right now because NVIDIA has been this major story of the year, powered by AI and Jensen Huang's vision there. Then at the same time, you've got Intel, which is in this very difficult turnaround. Pat Gelsinger is trying to get that done. They report Thursday this week. All of that is sort of wrapped up in this index. You got some names that have really high valuations and some that are being given up as yesterday's story.
It is really interesting, and it does make the case for active management because you can find different types of setups, both these basing phases, which you could argue that Intel has created, and then also these strong uptrends, new all-time highs in the likes of NVIDIA. And yet we think some kind of barbell type of strategy is appropriate with that in mind, where we have some that look like turnarounds. Another good example of that would be the cloud computing stocks like CRM or the ETF, which is CLOU. Those look like long-term turnarounds, but short-term they are starting to lose some momentum. So we don't know that we have a great entry here. But if we own them, we want to have that balance with positions that have that long-term upside momentum. Ideally, those like NVIDIA that are at or near new highs, and reducing exposure, of course, as we see sell signals arise.
Now, I don't remember what all is in these indices, but when I'm thinking about cloud stocks, SaaS, enterprise software, Adobe on the one side, which had dropped quite a bit after the announcement of the Figma acquisition, has come back a lot. And then you've also got names like HashiCorp that are recent IPOs, but some wind has come out of the stock sales there. So similarly, you've got bifurcation right within these indices that probably a little bit unusual.
Well, it's interesting. When we're seeing these stocks react to earnings, if you see gaps down, that is a negative development and something to respect and at least keep an eye on if you're positioned there. But we're also seeing a lot of breakouts, and breakouts have been seeing good upside follow through in this environment. So we would give a chance for many of these names to report earnings, see if they can clear resistance on their chart as a case to hold them. And yet we're also watching very closely a couple of metrics from a technical perspective to dictate reducing exposure. And that one would be the 20-day moving averages. It's a really easy thing for folks to watch from home. When the 20-day moving averages start to roll over, we feel like we have enough of a loss of momentum behind that security to dictate at least a reduction in exposure. It doesn't mean you sell the whole thing necessarily, but at least pare back to avoid a significant pullback. And if you look broadly speaking, triple Qs, the SMHs, they all do have the support of the 20-day moving average still. When that changes, we would be somewhat dynamic in our positioning.
All right, Katie Stockton, taking stock of the charts.